The single most important determinant of the UK's economic outlook remains the nature and timing of Brexit. The perceived likelihood of a no-deal Brexit has increased since the end of last year, and although the degree of preparedness for such a scenario has improved, material risks remain. Most risks to UK financial stability, from disruption to cross-border financial services in a no-deal Brexit, have been mitigated. However, it's still the case that in absence of further action by EU authorities, some disruption to cross-border financial services is possible, and though such disruption would primarily affect EU households and businesses, it could amplify volatility and spill back to the United Kingdom in ways that cannot be fully anticipated or fully mitigated. And though the readiness of the UK economy for no deal has improved since the last FSR in November, material risks of economic disruption remain. All of these risks must be weighed against the resilience of the core of the UK financial system. And taking into account the following factors, namely the progress in addressing major cross-border risks to financial stability that I just referenced, taking into account the results of the Bank of England's 2018 stress test of major UK banks, which encompassed even a worst-case disorderly Brexit scenario, the fact that major UK banks have maintained Tier 1 capital levels of around 17% of risk-weighted assets since the stress test, and that is over 3 times higher than they had before the global financial crisis, that major UK banks have built over £1 trillion of high-quality liquid assets, enabling them to meet their maturing obligations for many months without accessing markets, and that they've pre-positioned sufficient collateral to be able to borrow up to an additional £300 billion through the Bank of England's regular facilities. Taking all of that into account, the FPC continues to judge that the financial system is ready for Brexit, whatever form it takes. But financial stability is not the same as market stability. In a disorderly Brexit, a range of UK asset prices would be expected to adjust sharply, tightening financial conditions for UK households and businesses. If a major economic stress were to materialize, the FPC is prepared to cut the countercyclical capital buffer, as it did in July 2016, which could preserve banks' capacity to lend to UK households and businesses by around £250 billion.